Good day, fellow investors. Monish Pabrai is one of the most famous value investors out there. He has now launched a relatively new ETF where you can invest with him. And what we're going to do, alongside also me sharing my opinion on Monish Pabrai, is to look at his investments one by one to see where is the best value now there, because on the categorization it should all be great value. Now, before we start looking at the businesses, I really like Monish's stories. He is such a great storyteller, narrator, works well for his marketing. However, sometimes I feel there are some questionable, let's say, things there, but that is also normal when you are a financial public person, because whatever you say in the 25-year career you have, when it is just a little bit wrong, will be used against you. Now, when it comes to my concerns, we can discuss that also over time later in the conclusion. It seems that he is using Buffett and Munger as marketing. The performance has been shaky the last decade, has been great in the beginning, then some things went wrong somewhere. The zero fee funds have disappeared. Now we are in a high fee fund environment, 5 funds, 6 funds, not really following what our teachers, Buffett and Munger, have been telling us. And I have also watched the last Pabrai Wagons Fund shareholder call reply. Perhaps this video will come out before or at the same time when the new video comes out. So if there is something interesting, we might do an update later. So here is how he got famous, doing good returns, and then buying dinner with Guy Spier 20 years ago with Warren Buffett, and from then the marketing started. And if we look at the performance, everything was great, I think till 2000 something, and then you can see here trashing the total S&P 500 by 10x, something like that. However, since then, if the cumulative return went down 60%, that means that the last 8-9 years have been not that good. So something hasn't gone well in Pabrai world. We'll discuss that too. But I'm not here to kill the messenger. I'm here to look at his ideas that here and there are really, really good. I think one was recent that we discussed a few months ago. Valaris is 50% up. He also called coal at the right time. So very interesting to watch what Monish Pabrai does and has to say. But there are other issues on how many funds does he manage. So we have private partnerships, Pabrai investment funds, the Pabrai Wagons Fund that we'll discuss, the Dando holdings that are already there. He also answered the question, how is he dividing the buying not to, let's say, give benefits to any fund there, and he has an algorithm. This day I buy first there, that day there, and that's how he spreads his 5 funds, things like that. But it gets a little bit complex when you look at this. Plus, this is also something that I got in my email 2019, zero India fee funds. We don't hear anymore about that. The performance up to 2020 wasn't that great. I think then he recovered something. Dando Yunon offshore funds, you can see here this is from some hedge. Very little, 85 million assets under management. So the question is here, if you follow Munger and Buffett, why do you need these funds? Is it perhaps to fund with new funds, with the wagon, to fund the old illiquid positions, which makes it then something very tricky to get out if things get ugly. And that is also one example here. I think he, with all the funds, has a great stake in Edelweiss Financial Services, which means that he cannot get out that easily. That's also something to keep in mind when it comes, just as a risk. I'm not saying anything against Pabrai, but he's perhaps making his life just a little bit harder. The concerns, illiquid stakes, the algos buying, and then who is deciding on which day you're buying what. When you're doing a lot, mistakes are okay, but Munger and Buffett always said, sit in your ass, do nothing, have one fund, zero fee or something like that, and then just enjoy life. I've looked a little bit on that zero fee that was discussed by Guy Spear. Shout out to Manish Pabrai by Charlie Munger, when he had no fee, but that was in the 2010s. Now, unfortunately, we have big fees that are not in line with what Munger and Buffett have been sharing with us. Then there was also something in the call here. He said that he had to sell something because of redemptions in a fund. Now, day one, we have this structure for the investor. Somebody, an outside investor, wants his money, and that leads to a new structure for the investor. So that also shows the difficulties of managing so many funds, but also the difficulties of managing other people's money, especially in a fund structure, and we'll discuss a little bit more of that. And perhaps some of you might ask the clarity there with the funds, with the India funds, what's going on there, with the stakes, with the liquidity, who is paying here for what's going on, and perhaps structuring better as you are an investor there on the next conference call would be very interesting to hear. I'm sure that everything is alright. Now, for all the comments that will discuss what I do, this is my research platform, has been launched in 2018 May. All the documents that have been uploaded are still there. All my YouTube videos are still on YouTube. I made mistakes, changed some things, restructured, but everything is here. Everything is explained. I can guarantee you I will make more mistakes in the future, but that's also the process of investing. And that's also what Manish Pabrai says, that if 5 out of 10 of his ideas work out, he'll be happy. And you can see here, I made money on this, but it was mostly luck when I started 7 years ago. And you can also watch this video of 15 of my mistakes that I made around the clock. If you have any questions, I'm always open. You can put them in the comments and perhaps we can discuss them. But if we go back to Pabrai's teachings, he's looking at the P ratio of 1. The difference between uncertainty and risk is also something that he makes very clear. Risk is, okay, losing money. Uncertainty is not knowing whether you will get 2 or 4. But if 2 and 4 are always positives, that's not risk. Uber cannibals, spawners, copying others, and then, of course, the wonderful marketing that you will see also when you look at the presentation of the Wagons Fund, Charlie Munger, Warren Buffett, everywhere. Only a few great investments held for a long time, and that is also his Wagons Fund principle. So circle the wagons like Warren Buffett did over time. Those are the principles. Hold on to great businesses for dear life. Don't pay fancy prices for great businesses. Wide moats. Reinvest capital at high rates without accounting gimmicks or much leverage. And this is the portfolio we will discuss one by one, and let's start immediately with Edelweiss Financial Services, Indian company, portfolio weight 20%. If you look at the market cap, 1 point something billion, if that is 20% of all the Pabrai funds, and he manages, I don't know, 1 billion, then he owns a big stake of the company. Dividend is 1.36%. P ratio here says 20. Let's see. His idea is that Edelweiss will spin off 4 or 5 companies. All of those companies will be valued at 1 billion or more over time, compared to the market capitalization of 1 billion. That is 4-5x over time. We have alternative asset management, mutual fund, asset reconstructions, housing finance, insurance side of things. So here you have 4 businesses. If those are worth 4 billion, that's a 4x for you. The stock has had its ups and downs. Also keep in mind that there is Indian rupee depreciation against the dollar over time, also something to keep in mind. But in general, we have 1.2 billion market capitalization. If we look at the numbers there, this is then in Indian crores, but everything is growing 15% profit after tax growing, so things are looking good. If I adjust, let's say, the 6 months profit to the yearly, so that will be around 450 crore. If I ask my new assistant just to test them out, Gemini compared to ChatGPT, that is about $50 million if I am not wrong. $50 million on 1.2 billion market cap is not that much. Okay, there is the 10-15% growth that they are expecting. However, it is a pricey P ratio. But they are expecting to keep on growing, break even on the insurance businesses, and then perhaps 2030 do a spin, reduction in corporate debt. They have been growing greatly, so high P ratio, of course. However, they expect to lower the debt they have by selling the businesses, the dividends, stakes in those businesses. There is this AAA IPO that's coming around April 2026, earlier or later. That's the uncertainty versus the risk. But when I look at things and what they are doing, this is private equity. So this is something private equity in India has done well in the world, so perhaps it is interesting. Now, one of that parts that they are owning is the mutual fund, and they have just sold a 15% stake for $50 million. So that's a good sale. Globally, if the company keeps on growing over time, that is something. That's another, the 50 million that we already discussed. Next steps, share transfer. They should get already some money in for that stake. And that stake is not 1 billion now, but around 300 million based on that valuation that has been sold in a stake. So those businesses still have to grow over time to reach that 1 by 1 to 4-5 billion market cap. All is consolidated as they own most of these businesses. I don't know much about India, I cannot invest in India, but what I know is that these are financial businesses. If there is a financial crisis in emerging markets, which happens here and there, it can look ugly. India has been booming over the last 2 decades. Of course, keep in mind the rupee a little bit down, so all good returns. But the key question is profits. What are the profits? All the profits that have been made by these financial businesses are with these tailwinds that's pushing higher the whole Indian sector. What if the spin-offs don't happen at $1 billion? Then you're asking for a margin of safety as a value investor. You need, when you're investing in emerging markets, you need a good margin of safety. What is it? The 1.3% dividend yield is not really the yield you expect from an emerging market. And India is one of the most expensive emerging markets. Yes, it can, but it's based on relative valuations and somebody else paying all that money for high PE ratios and the promising growth, eternal growth of India. It should work well. If it doesn't, you will not likely lose money, which is also key. So it might not be 4 billion, it might be 2, and that's also okay. The next one is from India, we go to emerging market, frontier market, Turkey. Turkish airports operating 15 airports in 8 countries. They're looking for growth constantly there. Still growing population, everything looks okay. The company is mostly owned 48% by Airports de Paris. Almaty is one of the airports that Monish Pabrai discussed in his video, saying that it might be worth 10 billion over time, just that airport, and the whole market cap of the TAV stock is $2.5 billion. So also there upside potential. But if we look at Airports de Paris that own the thing, so they have this Turkish Airways, they also own India, and you have Paris. If you look at what they are doing, okay, they have cut the dividend, they are investing a lot in Paris, but then I can look at Turkish airports, they have these service companies, so growing, good ownership there. And you can see here with the Almaty airport that it has no expiration date on the airport. So they bought it flat out, which is something very rare. Most airports have concessions, pricing issues, and things like that. So that is something very interesting. Revenues are growing, but again, if we look at the profits there, EBITDA, yes, 500 million times 10 for emerging market minus the debt, and then you get to the market capitalization of 2-3 billion. So not really great value there. But if you look at things, this will be developed. Same here as GMR and things like that. That's the growth side of Aéroports de Paris. So that might make it interesting. There are capex spending. They have cut the dividend. Something Monish said that they might return the dividend. But even if they spend, as they say, 50% of cash flows or net income on the dividend, when that happens and the growth continues, that might be a 2.5% yield plus 8% growth, all else going well, and that is 10% return. But this is Turkey. You are not really there for a hopefully maybe 10% return. If you invest in Turkey, you want a 10% yield now and the growth. That would be perhaps more fairly priced, in my opinion. It's still Turkey. Then we have Warrior Met Coal, just a mine, replacement cost to build it, over 5 billion. And the idea there is that coal will get in demand again in the future, that prices, when there is a boom, will explode, huge cash flows, good returns from these coal businesses, met coal, growing global development, India requiring more steel. And there has been a downturn here. You can see that here they were washed in money. Now there is a downturn, a little bit recovery there. The stock already recovered, but they are not making much money now. But on top of the recovery, there is also the new mine development. So they are going to increase the production below budget, on schedule, ahead of schedule. All looks good. Blue Creek will be among the lower cash cost producers of metallurgical coal, higher quality, and depending on the price, you can see here that value of the mine will be 30 or higher per share. Unfortunately for us investors, we can say the stock is gone from that investing margin of safety perspective. 4 billion already, it's not 2 billion already. Who knows, maybe even Monish sold over time. We'll see that also same there for Alpha Metallurgical Resources. If you didn't like India, if you like Turkey less, well, you have something even better, which is Mongolia. Mongolian Mining Corporation, another coal play. I've looked a little bit, they are developing a new gold mine, which might be interesting, leading to good cash flows. Perhaps when they are at full capacity, there should be cash flows, dividends, things like that. So if that happens, even if EBITDA was lower on the coal, might be interesting. I am not going to look into this. The market cap, 1 billion, so okay, not a great position. However, the CEO has been shilling shares for a while now. That is also a questionable action. Okay, you can sell shares for all the reasons, but you never know what can happen there, politics, things like that. So I didn't dig deeper. If you want, here is an idea. Then we have the home builders. Capital light have been doing great, but the P ratio is still very low. Strong buybacks pushing the stock price higher, not a focus on dividends. I look at things, those things look stable there. So a slowdown in the homing industry, but still high cash flows, high buybacks, that's high percentage of the market capitalization, good returns on equity, debt to capital ratios going down. Everything looks good here. High equity compared to the market capitalization. Long-term investment thesis needing more homes in the United States. You look at the numbers, Sven, everything looks great. You should invest in the home builders. But as a son of a value investor, I always look, okay, give me a proper downturn, and then we can look at the best things to recover from the downturn. Now it seems I'm investing at the peak. It might do well, but this is the peak of the environment, peak stock prices. I had to invest here if I wanted. The same things were in place. So just based on it looks too good, I'm not going to invest. It might do well. Probably Monish knows much more than me. Another idea is US car dealership, same story there, P ratio of 8, buybacks, cash flows, a little bit declining profitability, but still very low P ratios. Here my worry is that they are also loaning on those cars that they sell. So if there is a big issue in the financing market, that might lead to issues down the road. But all else equal, looks cheap, but I don't know whether the focus is on dividends or buybacks. Offshore, Valaris, I don't know whether he sold it as it went up. I don't see it here, but the drilling ships are there, cheap compared to value, so perhaps there is some upside, but that was the story that we discussed a while ago. Now, when it comes to my opinion on this, there are big limitations when you're a fund manager. You have to be always invested. If he says, oh, I'll be 50% in cash, and he charges you 2%, 1.8, 5.5% on that, you're not a happy investor. So that makes him also take more risk. That's inevitable, and some of these plays are risky. But he says, if 5 work out, the other 5 give me a 0, the return, as he expects, is to beat the Nasdaq and the S&P 500. So Edelweiss, India, high valuation, growth, emerging market crisis risks, too crazy for me. Turkey, high valuation for Turkey, all good, looks good business, growth. Next cycle, when will the next cycle happen? Will likely happen, perhaps the stock is already gone, so too late for me there. Mongolian Mining Corporation, see how it fits you. Same on the coal there. Home builders, give me a recession, bubble bursting, things like that. Same there, P ratio, low P ratios, value replacement. So the problem I have is it's hard for me, and that's the beauty of investing, to find the conviction that Monish has to buy any of these names. I simply don't see it. I want that value slapping me in the face. I was looking at Valaris when it was really cheap at these coal prices. I bought something else. Okay, it's related, but that's also Pabrai's, let's say, influence. But I need a little bit more of beauty, because in a crisis, emerging market, and those happen here and there, this will look extremely ugly. Plus, there is the large redemptions that might hit, also force him to sell into a negative market. That would look even uglier. And then going back to the marketing we discussed at the beginning, exceptional investment, few great investments held for a very long time. Great businesses and hold on for dear life. Moats, wide moats, reinvest capital at higher rates with no gimmicks or leverage. When I look at this, truly great businesses that you say, wow, everyone has something, financial gimmicks, airports, but it's Turkey, Kazakhstan, that cannot be beautiful. So there is some question marks, but I'll keep following Pabrai because there is always something to learn. And if I look at the returns there, I have calculated 1% here, 2% here, 5% here, 10%. P ratios low here, so on average 6% plus the growth minus the risks. Let's say we give him a 9% expected return with some emerging market Mongolia risks right there. I will put it here on our research quadrant. And then we'll keep following, we'll keep listening. I always enjoy listening to Monish, always learning something. So why not also discuss it here, and perhaps over time there will be something to buy. Hope you enjoyed this video, thanks for watching, and subscribe so you can keep following.